Welcome to Inside the Wall analysis of the Coca-Cola Company's Q3 fiscal year 2025 financial results. The quarter highlighted revenue growth that was driven entirely by pricing despite flat volumes. A headline margin surge largely due to the absence of prior year charges, sharply mixed regional performance, and a still material IRS tax dispute that remains a major overhang for investors. Net operating revenues grew 5%, driven entirely by a 6% contribution from price and mix. However, global concentrate sales volume remained flat. The reported operating margin expanded to 32%, but a critical $12 billion potential IRS tax liability remains a significant risk. Looking at the revenue drivers, consolidated growth was 5%, primarily from the 6% price/mix contribution. EMEA led regional growth at 10%, while Latin America saw a 4% decline due to severe FX impact. The data confirms that growth is heavily skewed toward pricing across all major geographies. Consolidated growth shows a positive 6% price contribution and flat volume. Margins are a key test of Coca-Cola's pricing power and operating efficiency, and the Q3 results tell a more nuanced story than the headline numbers suggest. Gross margin improved modestly to 61.5%, driven by pricing and the continued shift toward higher margin concentrate sales from refranchising, partly offset by higher commodity costs and FX pressure. While reported operating margin jumped sharply to 32%, this move is misleading, as it largely reflects the absence of over $1 billion in prior year one-off charges tied to the Fairlife acquisition. On an adjusted basis, operating margin expanded by a more realistic 240 basis points year over year, indicating genuine but not extraordinary operational improvement. SG&A was slightly lower overall, with reduced incentive compensation offset by higher advertising spend. Overall, Coca-Cola is structurally improving profitability, but the reported margin surge overstates the true underlying progress, setting the stage for a closer look at cash generation next. Cash flow provides a clearer picture of Coca-Cola's financial health than earnings alone, and over the first 9 months of fiscal year 2025, there's a notable gap between profits and cash generation. Operating cash flow was $3.7 billion versus net income of $10.8 billion, largely due to non-cash items and significant working capital outflows, including the impact of large one-off payments related to the Fairlife acquisition and prior IRS tax deposits. After $1.2 billion of capital spending, free cash flow totaled $2.4 billion, reflecting stable underlying cash generation once these distortions are adjusted for. On the balance sheet, Coca-Cola carries $47 billion of total debt and $35 billion of net debt. The liquidity remains strong, with over $13 billion in cash and short-term investments and ample unused credit lines, supporting financial flexibility as the analysis turns to segment performance. Geographic performance diverged. EMEA showed balanced 10% growth. Latin America's strong pricing was erased by foreign exchange headwinds, resulting in a 4% decline. North America's 4% revenue growth was purely price-driven, as volumes fell. Coca-Cola faces a major IRS tax dispute centered on transfer pricing, where the IRS reallocated over $9 billion of foreign income to the U.S. for 2007 to 2009 after rejecting a long-standing methodology. The company paid a $6 billion deposit to stop interest accrual while appealing, but the bigger risk is a potential $12 billion incremental liability for 2010 through 2024 if the IRS approach is upheld, which could also raise the effective tax rate by about 3.5%. Recent court rulings, including a reversal in the 3M case and the Supreme Court's rollback of Chevron deference, are viewed by Coca-Cola as developments that strengthen its legal position. Strategic priorities include the continued use of pricing power and the ongoing refranchising strategy. The company must also watch the body armor trademark risk. The 2025 outlook includes $2.2 billion in CapEx. In synthesis, Coca-Cola is manufacturing growth through its pricing power, while global volumes stagnate, highlighting strong inflation pass-through but limited demand growth. The surge in reported operating profit was largely a one-off accounting effect from lapping prior Fairlife charges. Beneath the headline, the underlying trend is solid but fragile, as the company relies on pricing power and refranchising to preserve margins rather than drive volume growth. Core earnings quality improved, with gross margin expansion and a 240 basis point gain in adjusted operating margin, though this is overshadowed by the unresolved IRS tax dispute. Looking ahead, results will hinge on pricing sustainability, volume elasticity, persistent FX headwinds, and the eventual outcome of the tax appeal. Thank you for watching this analysis of Coca-Cola's Q3 2025 results. Please subscribe and leave us a comment with your thoughts.